Okay, let's get going. Welcome, everybody, to Practical Option Tactics. The special night tonight. This is a standalone class that I would have taught eventually had we not been doing the mini class this weekend. But we have the Unbalanced Condor mini class this weekend. And yes, I will be bringing up Unbalanced Condors, BWBs, Unbalanced Butterflies. Um, and I probably should make that more clear to everybody who's attending. But we've been doing so many unbalanced condors that that was really what was requested. But you can't really do an unbalanced condor without comparing and contrasting it to the BWB and the unbalanced butterfly because they're almost exactly the same thing. Um, Now, it's not immediately apparent when comparing graphs how they're almost exactly the same. So that's what we're going to be talking about tonight. We're going to be starting out with the very basics. This is going to be a review to get everybody up to speed for the class on Saturday, but we're not going to spend a lot of time on it. We're mostly going to just talk about how these three strategies really compare and contrast because on Saturday, you guys are going to be getting a ton of criteria. When to use the BWB versus the unbalanced butterfly versus the unbalanced condor, how much to pay, the strike separation, the distance between the strikes, all the different questions that you could have before entering a trade, how much to pay, when to get in, when to get out, etc. And so that we don't have to waste a lot of time on Saturday going over how these things are similar. I figure I'd spend the next 90 minutes of the class tonight getting everybody on the same level playing field. And I might do this for every mini class in the future. We only do about 4 mini classes a year. And really, in hindsight, this is probably the most logical way of doing it because everybody's got questions of how these three different strategies really, compare to one another. And so that itself is a valid pot class. But leading up to the pod class, we can have a primer and save, or excuse me, not a pod class, a mini class. We can have a primer and save a huge amount of time in the mini class delving right into the meat. And I know most people, when they're in the mini class, want to get as much meat as possible. They want to know when to buy, when to close, what expiration to do it in. When do I do the BWB versus the condor versus the butterfly? How much to pay, etc. How do I spread it off? And that's what you really want to get out of a mini class. And so we're going to probably, the next mini class, do the same thing where the pot class leading up to the mini class is going to be just the same format. So I want to welcome everybody. Before we go any further, though, I have to go into the disclaimer that just says we're giving out education, not advice. And by participating in this session, you are agreeing to all disclaimers. And the session is being recorded. So you can watch this as many times. If you're new and you're a little bit confused, watch this as many times as you can until you're not confused so that you hit the ground running on Saturday, full steam ahead. We're only going to have 6-7 hours together. And then an example. Now, let's clarify the example real quick. I said I'm going to do one, maybe two examples, depending on the success of the first one. If the first one's kind of a wash where nothing really happens, I'll do another one. But the great thing about the example that I'm going to be doing is I'm going to say why I chose the unbalanced condor versus the BWB versus the butterfly, unbalanced butterfly. And we're going to use that example to solidify everything taught on Saturday. Now, you'll recall that from the pod schedule, we we purposely had the unbalanced condor scheduled for today, and then next week, I don't know when, I don't know what day, but you will be, for those who are in this class and participating in the mini class, you will be getting a Slack update so that, or a Slack invite, excuse me, so that you can get pot and Slack updates as it pertains to this example that we do. Now, you'll recall that it starts at 9 a.m. Chicago time and it goes until 3 p.m. I will go longer if you guys have questions. Probably 75% of the mini classes I've done, I've thrown in a bonus day, be it an hour, 2, 4 hours, whatever it takes, so that any unanticipated questions that come in that require a whole bunch of information or slides, preparation, etc., you get. I'd rather have you guys get more than less. But right now it's scheduled Saturday only, 9 a.m. to 3 p.m. And it is going to be recorded. So let's get into, whoops, there's a mistake. I shouldn't say collars. Let's clear up the confusion right now of how these three different strategies compare and contrast, because I've never seen this done the way I'm going to show you. I've probably I taught at 2.5 firms. I was the lead instructor at Trade Secrets and at Optionetics. Then I had my own firm, Random Walk, that morphed into this. And I am always guest speaking at other firms. And I've never ever seen in text or in a classroom environment a comparison of these strategies, let alone where it's normalized for risk. Any remedial comparison of the two, I think most instructors are afraid to attack, because when you overlap the risk graphs, it gets all funky, and it's like trying to compare apples and grapefruits. It's not a fair comparison. So I normalized it, risk versus reward, which would only make sense, but I've never seen it done before. So you're going to get something a little bit different towards the end of the class. And let's clear up the confusion in the meantime. Remember that a butterfly is just a long and short vertical spread, either calls or puts, joined at a common center strike. The BWB, when I created that with a couple other guys on the floor back in the mid 80s, way before these guys were saying that they invented it in 2000, when I created it, it really was a way of minimizing capital outlay. And all I did was take a normal butterfly that would have a debit and sell an extra vertical spread further out of the money to help pay for it. And when you look at the time decay with a day to go until expiration, it's a very safe position as long as you babysit it. What it is just a long vertical spread and a further out of the money vertical spread that's wider than the one you bought. And they have a common center strike. Now, an unbalanced butterfly, otherwise known as the 1-3-2 trade, is just a vertical spread, say $5 wide, and twice as many short vertical spreads, 2 times 5, that share a common center strike. A lot of times you'll hear me refer to an unbalanced butterfly as a 1-3-2, simply to avoid people getting caught up in the emotions of the moment and confusing it with the unbalanced condor. Now, a condor, everybody should know this, is a long vertical and a short vertical that do not share common center strike. And then the unbalanced condor is simply the same thing as a condor with an extra sale of vertical spreads to lower the cost or debit similar to the same philosophy or thinking, the modus operandi as the BWB. Okay, so hold on a second. You want some people ask for strikes? Okay, let's go to the strikes. And here's a butterfly. Actually, you know what? Let me put them in the slides so it's better than my writing. I'll give you some for examples in the slides. That might have made sense. But again, this is why sometimes I have mini classes and then an extra day. I can't anticipate what questions are coming in unless I taught the class before. But let's say for just an example on the slide, some people ask for a strikes 4130, 4125, 4120. Put. Okay. Now let's go to another one. Same example or same thing where I put in strikes on a EWB. We'll start with the same strike of 4130 just for comparison purposes, 4115 and 4095. And then we go on to the next one, which is unbalanced butterfly, otherwise known as a 132. And you might see buy one 4130, sell three 4105s, and then buy two 4080s. And again, for continuity, we'll just keep it all puts. And then for a condor, we'll just use a little baby remedial condor, $5 wide, 4130, 4125, 4110, 4105 put. And then an unbalanced condor, we'll do buy one contract of the 4130, 4125 put, and sell two contracts of the 4095, 4090 put. Okay. Oh man, let me expand this window. I got questions coming in. I can't read the whole text. No, the unbalanced condor is not the same as the iron cockroach. The iron cockroach is simply the sale of an iron condor where one side, the call or the put, has a wider spread. So, for example, I guess the best way to do it is pull up Thinkorswim. Someone asked what an iron cockroach is, and that really doesn't compare or doesn't really come into play here because it's a whole different family. So there'd be no reason to compare the iron cockroach to the, well, this is the girl's account, obviously. Here. The iron cockroach is a way of selling premium, just like an iron condor. So let's say we wanted to sell an iron condor, and the market is at 41.58. So we could sell the 41.50, 41.45 put. So that's a little bit out of the money. And we'll sell the 41.65, 41.70 call. And you can see that this is trading for $4. If I sell a $5 call spread and a $5 put spread, it's trading for $3.85, $3.90, somewhere around there, $4. Now, if we close anywhere between, here's the call and the put, between 65 and 50, we keep all the premiums. And that would have been a great thing to do last week when we were stuck in $10 ranges. Now, an iron cockroach is sort of the same thinking as an unbalanced condor or a BWB or an unbalanced butterfly, in that we're going to sell an extra unit to bring in more money, but we're going to have risk. So let's say I'm not as bearish as I am bullish. I think the market has more room to the upside than the downside. I can pull my put strike down from the 45 to the 40 and bring in $5.40. Now what you see is that I have a $10 wide put spread that I'm sold and a $5 wide call spread. I bring in $5.40. So if the market goes up big to 4,200, I'm going to lose $5 on my call spread, but I brought in $5.40. So I'm going to still make 40 cents. If we sit between these strikes, I'm going to make $5.40. But I do have risk to the downside in that I sold a $10 spread here, and so I'll have $5 of risk there. So let's graph it out, and then I'll move on. But sometimes the graphs help visualize it. Okay, now here's the iron cockroach. It's very similar graph. Okay, it's a very similar graph to if we bought a put, an unbalanced put condor. So it's very similar. It is best used when volatility is extremely high, or you think the market is going to just sit. But if you take a graph of an unbalanced condor, and I'll pull up one real quick. Here's an unbalanced condor, and there's an iron cockroach. They're going to be used to create the same sort of a profit zone, but you will see that with this iron cockroach, well, this unbalanced condor, the strikes at the bottom, you can see we're looking at the 30, 20, 10, 4100, 4090, when the market closed up here at 58. So this is an out of the money spread, and we're hoping the market goes down slowly. Whereas the iron cockroach, we closed right at this vertical line right here, and we're hoping the market just sits. So it's very similar graph to unbalanced condor. It's created with calls and puts, whereas the unbalanced condor create it with just calls or puts. I guess you could do calls and puts if you did it synthetically, but it's at the money. It's more like selling a straddle or a strangle with limited risk. Okay, and the next time volatility spikes dramatically higher, I'll do an iron cockroach. We have not done one in a long time. It's probably good that we circle back to it and do at least a one lot, and keep you guys familiar with all the different tools in the toolbox. Okay, so those are really the things that we're going to be discussing. And in the unbalanced class this weekend, we're going to primarily focus on the BWB, unbalanced butterfly, and the unbalanced condor. Now, we all know that a butterfly has a very limited amount of risk. Whatever the debit is what the risk is. And the same thing with the condor. Now, the problem with the butterfly and the condor is that we're not taking advantage of time decay. Yes, if we have a butterfly on, okay, or a condor on, and the market opens up on expiration day, right at the center strikes, time decay will be our friend. Okay, because at the end of the day, the butterfly and the condor are going to be worth the maximum value if we close at the center strikes. But we haven't been using those. We've been using the BWBs, the unbalanced butterflies, and the unbalanced condors, graphs like look like this, to take a directional bet. And at the same time, when the market's right here and we're bearish, or the reverse with bullish, but using the sale of extra units to take advantage of time decay. The three trades we're discussing tonight and comparing tonight are all to take advantage of short-term, one-day time decay, which is the thing right now. Everyone's doing the zero DTE trades, and they want to trade something that's just going to rot dramatically. So here with the BWB, what is the time decay? Is an extra extra spread sale. Okay, it's an extra sale of a spread. The unbalanced butterfly has an extra spread. It just happens to be at the same strikes as the existing spread that we're short. And the unbalanced condor, the same thing. All have an extra sale. Why? Because of the normal distribution curve. We're taking advantage of time decay, which is our best friend in the world. I don't know where Delta is going to take a position. In other words, I have no idea which way the market's going to go the next day. I have no idea if the market is going to increase or decrease tomorrow in terms of the ranges. So gamma, I can't guess. Volatility, we'll call it, is in the mean, and typically doesn't change much from one day to the next unless we get a big move, but I can't predict when the big move is going to come. The one thing I can predict is that tomorrow the options we sell are going to get crushed because of time decay. We saw that today. We saw that yesterday we started a razzle dazzle and we sold the 60, 65 call spread at 30 to 40 cents, depending on where the broker filled you, but it was trading about 30 or 40 cents. Today, the market was up 25 points and we closed it for 10 cents. So if we sell a call spread and the market goes up, it's not a good feeling. When you sell a call spread, you want the market to sit or fall. But here the market was going up, but because of 1 day of time decay, it had gone from 40 cents to 10 cents, even though the market went up a half of a percentage point. That is what a lot of people who are doing the zero DTE trades are doing. Also, the people who went to the alchemy class are loving the time decay of these unbalanced spreads. Why? Because they start an unbalanced spread out that looks like this. Then they reverse it because of the time decay the next day. And what they're left with is a trade that looks like this in pink. And they've got a butterfly and a condor on for free or for a credit the next day with very low risk. Now, there is risk, and the last one blew up on us. Okay, very rarely do they blow up on us, but the last one we did, the market was up like I think 75 points a day or something. Those weird days, you're going to scramble, but for the majority of times, this works out beautifully. And that's what people love. Why? What's this phenomenon? Is the time decay. The graph starts out like this at the end of the day. Tomorrow morning on the open, because of the overnight time decay, the risk graph looks like that. And the expected ranges have decreased dramatically. They've come in for no other reason than time decay. This much on this side and this much on this side. And that's the purpose of it. And the people who are taking alchemy class and loving zero DTE trades have been begging and pounding and screaming, I want an unbalanced class. And I should have called it unbalanced instead of unbalanced condor, because we are going to be talking about unbalanced butterflies, BWB, which is an unbalanced fly, sort of, and an unbalanced condor. Okay. So to wrap all the way back 360 degrees to the question, is the unbalanced condor the same as on an iron cockroach? It's very similar graph, different construction. Okay. Different alignment of where you want the market to go. Different pricing, etc. Oh, DTE stands for days until expiration. Okay, and don't feel bad if you don't know what DTE is. Okay, you're going to start seeing this all over the place. Zero DTE. Why? Greater than 50% of all option volume right now is in the 1 day to expiration options. So tomorrow, more than 50% of all option volume will be in the May 18 expiration. And like everything in trading, somebody comes up with a shortcut or a new name for something, and then once in a while it sticks. And zero DTE is sticking. I'm not a fan of it, but it is what it is. Okay. So let's get going. Now, I took today's option chain at the close for May 19th expiration, Friday. It'll probably be a little bit different now than when I took it a couple hours ago, but not much. I think I took this a couple hours ago when the minis were down about 4. Minis were unchanged when the class started. So the prices will be a little bit different. All of these are puts. So if you look to the left side of the screen, what you're going to see is expiration is the 19th. I faded out the information that's not really important, like the bid. We usually price spreads ask to ask, so we don't need the bids. It's just to make it look less busy. With the market closing at 51.58, 150, or excuse me, 41.58, obviously the 41.40 put is out of the money. The ask price is 970. And here's how you read the sheet. If I'm looking for the 35.40 put spread, the math is already there. So if I'm looking at the 35.40 put spread, $5 wide is right there. If I'm looking for, here's a $5 wide spread, $10 spread would be the 40.30, and it's going to be this price. Okay, it's going to be 730 minus 970. This is all these $5 and $10 spread prices are just so you don't have to do it yourself, just to make your life easier. And then what we're going to do is we're going to compare a standard butterfly. Right here, you can see that the 30, 25, 20 butterfly $30 strike, 25 strike, 20 strike butterfly. It's trading for 15 cents. That's where it closed. Then on the BWB, we're going to deal with the 30, 15, 95 BWB. On the butterfly, unbalanced butterfly, we're going to be buying one spread here, and we're going to be selling two spreads here, and that'll cost 30 cents. Okay, there's a mistake here. This should be 1 and 1. Okay, and this normal condor is a 30-cent debit, and then the unbalanced condor for a 20-cent debit, I can get this separation. Notice how I get more separation from the unbalanced condor than the condor for about the same price. You got it, Art. Art, you get a t-shirt. You got my mistake. So tell the office what size you're in. They'll send you one out. So, Art, you probably got a whole dresser full of just our shirts. Anyhow, Art's cheap. He just doesn't want to ever have to buy a t-shirt ever again in his life. So he pays attention and catches my mistakes. Don't worry. Get a third dresser, get a fourth dresser. We got a lot of shirts. That being said, let's look at the purpose of this sheet before I go any further, because this is really important. What you're going to see are the butterfly. And again, this is 1. Art got it. This is 1 and 1. Okay, and I'll change it on the slides before I send it to you guys. The BWB, the unbalanced butterfly, the condor, and the unbalanced condor. You're going to notice they're all between a 15 and 40-cent debit. I purposely started all the spreads at the same strike. You see our first buy is at the 30 strike. And then went as wide as possible so that we're in the same ballpark of roughly a 30-cent debit. Now, I couldn't make the butterfly any wider because it went from 15 cents to 60 cents. But this is really sort of the criteria I use, and you'll these should all feel familiar. You've got see me do butterflies for 10, 15 cents. You see me do BWBs from 0 to 40 cents. You see me do an unbalanced butterfly for 30-cent debits. You see me doing condors for 10, 20, 30 cents on a leg or 30 cents as a package. And you know that our unbalanced condors I'm trying to get for 30 cents or so. And sometimes we've done them for 20 cents or even zero. So this is all really comparing apples to apples based on the prices that we closed at. That's the most fair thing I can do to compare what a butterfly, a BWB, unbalanced butterfly, a condor, and an unbalanced condor all are. Okay, now let's graph each one of these out, starting with the butterfly. Okay, here's the butterfly for 15 cents. It's a simple little $5 wide butterfly. 2 days to expiration. What do you think the odds of the market closing at 41.25 is on Friday? Would you want to pay 15 cents for this butterfly? Given what you know about the SPX, how much it moves, and the likelihood that we're going to close anywhere near the 25 strike 2 days from now, the odds are very slim. I'm probably just throwing away 15 cents. Wouldn't you agree? Sure, we can get lucky. The market can fall down to, say, 30, 20, 15, somewhere around there, and hang out there on expiration day, and this butterfly will go to 60 cents, and we sell it out and we get lucky. We may even get to 41.25 and hang out half the day, and it gets up to 80 cents. Are you going to hold on to it until the last hour of expiration where we get buy and sell programs that can move the market $10 in the last minute, hoping we make $5 on this trade? No way. No way. As a matter of fact, while I was looking in the girl's account, I saw something pretty clever. Here, if you look at how the market closed today, in the last 15 minutes of trading, we were above 60, almost 62, and I see that they have the 65 butterfly in size here. Okay, look at it. 65 is the center strike of sales. Now it's kind of messy. I can think I see what they got going on here. Basically a butterfly with a couple extra units. But what I saw real quick is this. Right on the close, they want the market to close at 65. We saw that the market was at 62. So if we closed at 62, the butterfly was going to close at $2. They sold one contract out at $1.25, even though the market with 10 minutes to go at the expiration was in between the strikes that would have hit a home run if we closed at 65. Why? Because they know anything can happen in the last 5 minutes. And guess what? When we closed at 41.58.77, this butterfly they sold for $1.25 at, I don't know what time it is, 250 something, went out worthless. They sold at $1.25. Had they not sold it out, it would have gone out worthless. And as a matter of fact, I bet they were trying to sell more. Let me go look. You know, they were trying to sell more at $1.65 and $1.80. and $1.90. So they had, I don't know, let me see, at least 6 butterflies and some extra units. They were trying to sell half of them out from $1.25 to $1.90, knowing that they needed the market up here at 65 to hit a home run on the butterfly. Anything above 60 is pretty much dollar for dollar profit. So if we closed at 60, call it 61, they would have made $1. 62, they make $2. It was looking really good for them. And then at the last second, we sold off. So this is pertinent to our conversation. Why? When you look at this butterfly right here, even though you only paid 15 cents for it, even with 10 minutes to go until expiration, if the market is at 25, with 10 minutes to go to expiration, we can move one strike away and we'll close under 20 or above 30 and the thing expire worthless. So it's not that great of a trade. As a matter of fact, when we were teaching about scalping and said the trade's going against us, would we rather buy a butterfly for 20 cents or sell a butterfly at 0 and hope it goes out worthless because we had a bad leg? We saw that selling a butterfly at 0 was probably a better do, especially if there's time until expiration where that butterfly is probably not going to hit. I would not be uncomfortable short this butterfly for Friday. It's a garbage little tiny trade. It's great for trading. It's great for hedging. It's great for spreading off. It's great for getting into it for free shots and stuff. But it's not going to be your bread and butter. Now, the broken wing butterfly is designed to remedy that butterfly. You don't want to pay 15 cents for it, so you move a tail down. You'll have a little bit of risk, but you'll get the trade on for even. Well, in the SPX, because of how much it moves, here's a $15 wide by $20 wide BWB for 40 cents. I'm not real happy about this trade because normally a 15 by 20 should be going for 0, and now we have to pay 40 cents. Now I can make it smaller and do like the quarter, or excuse me, the 30, 20, 05, which would be $10 by $15, but that's trading for 0. We can move $10 in seconds. This is too much risk. I will never do a $10 by $15 BWB. This doesn't give you enough room for protection. I mean, let me show you the graph. Okay. We could go through all those strikes real fast and end up with a losing trade. And this purple line of what the trade looks like prior to expiration doesn't offer a lot of protection. The problem is we're at extremely low volatility levels, and that's why to do a 15 by 20 BWB, we're actually having to pay for it, but that's fine. Why is it fine? Because it's going to be very similar in pricing to the unbalanced condor and the unbalanced butterfly. and that's going to make sense in a little bit. Let's talk about the unbalanced butterfly. Here's a graph of a 4130, 4105, 4080, 132 unbalanced butterfly. Okay, so what this is we're buying the 4130, 4105, and this is a $25 wide butterfly, vertical spread. We're buying one, and then we're going to sell two of the 4105, 4080, $25 wide spreads. And you see that that's trading at a 30-cent debit. Now, the beautiful thing is the time decay on this. You see it does have risk though. When you're dealing with the condor and the butterfly, the only risk is what you pay. In order to get this cost down, we're adding risk by selling extra units, because a $25 white butterfly is going to be very expensive as a package. If you wanted to buy a $25 white butterfly instead of the unbalanced, look at the price. Let's say you wanted to buy, oops, a $25 butterfly that was a traditional butterfly with equal separation. It's going to cost you $2 instead of, or $1.95 instead of 30 cents. So the sale of the extra spreads is to get our debit down so that if the market goes up, we don't lose much. The same thing with the condor. As a package, we don't have a lot of risk, just what our debit is. 30 cents on each side. We need it to close between 30 and 05. If the market goes up or down big, we're going to lose the 30 cents. So we've been learning, take advantage of the time decay, widen this condor out to a bigger range, but have some risk below where you think the market can't go. The same philosophy as with when you learn the BWB. Okay, here's the unbalanced condor. Same thing as the condor with an extra unit of sales. You see how instead of a condor like this, we have a lot more profit potential, but it comes with some risk. Okay, nothing new to you guys. If you put them all on one sheet, there's the graphs for comparison. Does this tell you anything though? Every time I've ever looked in a book or in another class, everyone's like, well, there's a comparison of all the graphs. How do you make sense out of this? Which one do you like the best by looking at these 5 boxes? Personally, just if I was new to trading and I looked at all these boxes, half of my brain is going to go, well, this is the best because it's only got 15 cents of risk. The other half of my brain is going to say, well, this has the greatest profit potential but I got a lot of risk here. This has the greatest range of profit, but it's only a $500 profit, whereas the BWB is not much different, but instead of $500, I can make almost $1,500. And I've got about the same amount of risk, right? Because remember, here's the unbalanced. Let me change colors. I have $500 of profit potential. On the BWB, that's the $500 line. The unbalanced condor has this additional amount of room to make $500. They both had the same amount of risk, but the BWB can make an extra $1,000 if we close near 41.15. And our costs are about the same. I don't know. I'm trying to put myself in a position of being a new trader, looking at these 5 graphs and having someone say, pick the one you like the best. It's yours. I almost sort of feel like what a car salesman does when you show up at a car lot. You say, I want to look at the Corvettes. And then, oh, I didn't know they were $100,000. I thought they were about 65 or 70. So then all of a sudden, well, have you seen the new, Chevy, whatever? You don't, obviously, you're not wanting a Chevelle if you came in looking for a Corvette. But they're just muddying everything up. So when it's time to negotiate, you're so confused. Everything seems like a bargain. It's done deliberately. This almost feels like I'm being confused deliberately. I've seen this in books similar to this, where here's the butterfly, here's unbalanced, butterfly, unbalanced, condor to condor, and to be, very seldom the BWB will be in there, but you get what I'm saying. How do these positions compare? From this, I can't tell. Which one would I pick? As a new or even an intermediate trader, I think I'm going to have problems looking at these 5 graphs and deciding which one's the best. Well, there's got to be a better way to compare and contrast. So here you see we're going to compare the BWB, the unbalanced condor, and the unbalanced butterfly. Here is the BWB. As it morphs into the unbalanced butterfly, you see that. And then to the unbalanced condor, it morphs into that. Unless you have an unbelievable short-term memory, this is still not adding too much better of a comparison. I still don't know which is the best of the 3. So I went a step further and said, what if we, instead of looking at it this way, what if we compare the BWB unbalanced condor and the unbalanced butterfly this way? Now, which trade do you like the best? Still not a fair comparison. That's a hint. It's a little bit easier to understand it when they're jumped on top of each other like this. But it's still, when you slow down a little bit to compare them, what do you notice? Well, I like this red line way up here at around 2,500, but it's also got risk down here at 2,500 of risk. Whereas the BWB and the Unbalanced Condor both have about $500 of risk. Is anybody confused yet from what I just said? This red line of the Unbalanced Butterfly looks really sexy on the way down because it's a $25 spread and a purchase and a $25 spread sale. So we're going to have $25 of risk. Whereas the blue line of the Unbalanced Condor and the BWB only have $500 of risk. If you're risk averse, those two would be the better trade. You see that because they're all priced about the same, the risk of them going out worthless is about the same. Because this is so profitable, those only worrying about money and profit potential are liking this. You may even be fooled, and it's a very understandable fooling, into believing that this is going to have the best time decay. And so I want to be in the Unbalanced Butterfly because it's going to have the most time decay because it has the most amount of room to drop. But we're not really comparing apples and apples. Remember in the alchemy class where I asked these guys, in a $30 butterfly, if we're looking at a $30 wide butterfly, actually because we're looking at a $25 one here, if we're looking at a $25 wide butterfly, which is what this is, 30 to 05, how many $5 wide butterflies are in a $25 wide butterfly? And nobody got it right back then. Now I see a bunch of people getting it right and still a bunch of people getting it wrong. And then I pulled up this graph. Wow, I'm so proud of you guys. About half of the people got this right. Very proud. If you weren't in the alchemy class, you're probably never going to get it right because of the 100 people or however many were in the alchemy class. Not one single person got it right when I asked this. Now, in a $5 wide butterfly, there's one $5 butterfly. In a $10 wide butterfly, there's four $5 butterflies. In a $15 wide butterfly, there's 9 butterflies that are $5 wide stacked up. Some people think, well, 25 divided by 5 is going to give me 5 $5 wide butterflies. But what all you're going to get is this. You're not going to get the $25 butterfly because you're not stacking them. So in the $25 wide butterfly, there's 25 $5 butterflies. So for the same reason that this gets a little bit confusing with butterflies, this graph is a little bit off because we're not comparing apples and apples. We're comparing, how do you compare one trade that has 2,500 of risk, 2,500 of profit, to another trade that has $500 of risk to $500 of profit. It's not a fair comparison. So I changed things up a little bit. So what if we do this instead? What if we double the contracts at a BWB, make it 2 BWBs, 3 unbalanced condors, compared to the unbalanced butterfly that's really wide? And I've never seen anybody do this in any book. If you guys ever read a book, an options book, where they're actually comparing it correctly, let me know. I'll congratulate the author. Here is something a little bit more fair. It's still not perfect. What I should have done to be perfect is 1 unbalanced butterfly. Well, this is about as fair as you can get, okay? Because of the profit versus the loss. Here you see nothing has really changed with the unbalanced butterfly. But when I take 2 BWBs, this is 2 BWBs, and this is 3 unbalanced condors. Remember, 1 unbalanced condor made 500 and lost 500? Now it's making 1,500 versus losing 1,500. It's a more fair comparison. I could almost kick this up to 4 contracts, but then it's going to bring the risk down to here. Profit potential. Yeah, maybe 4. Maybe 4 would have been better. You see that they're very similar when you notionalize it of risk versus reward. That's why I've always said to people, hey, these unbalanced butterflies, BWBs and unbalanced condors, they're all very similar. The only real difference is a little bit of how they decay, a little bit of the range you expect for the next day. Which one has the best range before you run into trouble? Usually the unbalanced condor, but it's also muted by its maximum profit. It's got a wider range of profit. It has a little bit less risk, but it has a little bit less profit. Where is your break even? Now, what you're going to see here, and I haven't brought it up yet, is this. I don't know if you can see that. On one of my screens, the resolution's great. But on this current screen, it's barely legible. But this is the EM for Friday, the estimated move. So we can expect the market to get down to about here based on where it closed in the current volatility. Okay. Merrick, you're saying the upper graph sink a little when you buy 3 instead of 1? Yes, you'll see that it has sunk a little bit more because it's got 3 times the cost. But the cost is still negligible. 20 cents times 3, it's not going to move this area here that much. It's barely noticeable. It is significant, it is a difference in dollars, right? $20 versus $60. But $20 versus $60 on a graph that's ranging plus and minus 3,000, you're not going to see these lines shift that much. Okay. Any questions so far? When you notionalize the risk and reward, they're very similar. When do I pick one versus the other? Sometimes, for some reason, because of skew, the unbalanced condors will be better on the downside. Sometimes the BWB or the unbalanced butterfly. And I go through at the end of the day, the last 15 minutes, you don't hear from me too often because for the last 15 minutes of trading, I'm answering emergency questions and I'm comparing the unbalanced butterfly, the BWB, and the unbalanced condor with calls and puts for the next day's trading in case we want to do one of these risk flies, and they all fall under the same category. They're all butterfly derivatives with risk involved for the next day in anticipation of trying to capture some time decay. So at the end of the day, you guys have always seen me do this. I'm always putting in these unbalanced condors or BWBs or unbalanced butterflies right near 3 o'clock Chicago time. Why? As discussed, when we're putting on unbalanced condors for the next day, and we're trying to capture time decay, the best way we can do that is by knowing where the market's stopped. Okay, we know that a 50-point move like today is usually about as much as we get. Once in a while, we'll get a 75 or 100-point move, but they're so rare it's not even funny. 50s do happen. 75s, I don't worry about because they're going to take you out no matter what. They don't happen much where we gap open higher or lower 75 points. I can't make a living betting that the next day is going to be a 75-point move up or down because it'll be 80 days between the times I place the trade and I get it right. 50s are in consideration. Estimated move is the best way to go, but sometimes when volatility gets too high or too low, it's not a real fair indicator either. Here we see volatility at 17% and estimated moves are tiny. I guarantee you we moved a lot more. Well, let's take a look. Okay, here. It's saying they expect the market to move up or down 15 points in the next 2 days. We just had a 50-point move today. Volatility's not really reflecting how the market moved today. So what do I take into consideration at the end? And I'll tell you what, we ran into problems with an unbalanced, and let me see what trade number it was. Trade number 66. We had the 4085, 4090, 4115, 4120 unbalanced for 1 day. And part of the reason why we ran into trouble is we had a 75-point gap open, but also I started the trade way early in the day. I didn't wait until the close. In other words, let me explain it this way, because this is really important. This is the estimated move line for Friday on the downside. So if we get down, if we're bouncing around and we're bouncing around, we skirt inside and we skirt out of the 1SD band, any of these things will start generating a profit. What we want is to close in the center area here. We don't want to close anywhere below 4,100. And what is really cool on all these unbalanced is that the break evens are below the support line of 4,100 that we kept getting down to all last week and bouncing. Every time we got down, we got down to like 40.96 and bounced, 40.98 and bounced. 41's a pretty strong support level. So none of these trades would normally scare me. Now, let's say I put it on tomorrow at noon. And all of a sudden, at the end of the day, news comes out that Joe Biden starts screaming at all the the Republicans, saying they said shut down this country. We don't care about the budget. It'll serve you right for all this green energy stuff. I don't see how we're gonna get out of this budget deficit, debacle. And the market, which was right here on at noon when we put the trade on, all of a sudden falls down to 4,000 in the last 3 hours. We fall 50 points in the last 3 hours. Not impossible. And the next day, there's still a day to go until expiration. The next day, the market is right here. Do we have a lot of room to the downside for the next day? Where we can't lose, where a lot of room to the downside where we won't lose money. We've got no room on the BWB. We have very little room on the unbalanced condor. We have 10 points or so on the unbalanced condor and the unbalanced butterfly. We're starting to sweat. As opposed to on the close, we close at 41.58. If we gap down 50 points the next day, we're still going to be fine. We've had these things down with puts where we did get down 50 points and we managed to do an alchemy trade where we took this blue line of the unbalanced condor. I remember it because I had a lot of emails and people Skyping me and calling me and saying, Scott, we got an unbalanced condor and we're looking down 50. Yeah, and you know what we ended up with? We ended up with something like this. We ended up, for no cost, we had a butterfly and a condor because of the time decay overnight, even with a 50-point gap down. So that is why I always wait until the end of the day. I understand people feel a little bit of pressure at 3 o'clock Chicago time. I all of a sudden start blasting out unbalanced condor orders or BWBs or unbalanced butterfly orders. And I'm like, Scott, man, the bell just rang. Yeah, but we still got 15 minutes. Either we're going to get filled or we're not going to get filled, but we still have 15 minutes. Even if it takes 10 minutes to get the order in. If the traders want to trade it, they're going to fill it. And that's why I wait until the end of the day. Now, people said before the class starts, what are the considerations that you do? And it's pretty straightforward. It's pretty down and dirty. It's pretty easy. Okay, I don't know what these girls are doing here. Anyhow, this is weird. Okay. Let's say they go on the close today are going to be about the same prices right now for tomorrow. Tomorrow is the 18th. So if we were looking for an unbalanced condor for tomorrow, what would I do? Well, the first thing I'm going to be cognizant of is where's my EM? And that's easy to find. Just there's a lot of different ways of doing it. I don't bother going to all the graphs or anything else like that. I just go and see. Where's the 16 delta option? Right here. Somewhere between the 25 and 30 strike. That's going to give me the 1 standard deviation. So I'm going to wish or hope my long is right on one side of the EM band. The closer at the money, better on the buy. But there's only so far I can get my buy towards at the money without having to move my sales up. What else am I looking at? Well, where's support and resistance? Well, if you look at a graph, for the last 2 weeks, 10 trading days, there is solid support at 4,100. So I'd like to be long the 30 strike or higher, and I want my break even at 4,100 or lower. And then what do? I just start playing real quick in my head. What do we got here? Now, if you're not really good at pulling all these numbers in the option chain and doing it in your head real quick, don't worry, it will come. I've been doing this a bit. But just pull up anything you want. Buy an unbalanced condor and just start adjusting the strikes. Okay, I know I want to be long to 30 or higher, so let's start at the 30. Go to the 25. And here. You see, this is a 15-cent debit. I've already told you I'm not going to spend more than 30 cents on an unbalanced condor. Because anything more than 30 cents is tough to get back. Let me say this again. This is extremely important. How many people have seen me buy an unbalanced call and the market opens up a little lower and we manage to break even on the trade? We do that all the time. Why? If the market opens up higher on this put one, let's say, talk about puts. My long put at the first strike, let's say we do this and then the 1005. My long put spread is trading for what? 70 cents, right? Here you see this is 40 cents, 30 cents. So the 1510 is trading for 30 cents. If I buy this unbalanced for 30 cents and the next day the market moves up, what's going to happen? One strike higher, this spread's going to go from 70 to 50 and then to 40. So $10 higher. The market can open up $10 higher. I can sell this spread at 40. My tail that I sold is probably 10 cents. So 40 minus 10 is what? 30 cents. I can do alchemy or close the trade out for 30 cents and get my 30 cents back. Yeah, I do have a bunch of criteria, but that's going to be a couple hours. Okay, I'm just giving you the down and dirty thinking right now. On Saturday, we're going to go through a huge amount of criteria, and that's why I told everybody all these unbalanced trades are so similar. When to go to the unbalanced butterfly versus condor versus BWB is somewhat subjective, somewhat pricing, somewhat personal preference, and somewhat the ability to alchemy. Okay, the unbalanced butterfly is going to be the easiest one to alchemy. Why? There's 25 butterflies in there. I can sell 3, 7, 9, 12, 15 butterflies to get some money back and still have a residual position. Remember, the $25 butterfly has 25 $5 butterflies in there. So I can sell 7 contracts of a $5 butterfly and still have 18 left. Then I can sell 8 more and have 10 left. Now, the unbalanced condors, some people really like because they're much easier to understand and they're much easier to flip, really, and anticipate what you're going to have left over. All you got to do is know when you're doing an unbalanced condor, if it looks like this, and let's say this is what calls. Okay, so we're buying 1, selling 1, sell 2, buy 2. Some people find the unbalanced condor really easy to alchemy because they know, okay, if I sell a spread here, I sell 1, buy 1, I got a butterfly, and I just got to buy something before these strikes 2 times. And I've got a condor and a butterfly. So all I got to really do is an unbalanced condor inside my original one. Whatever my original strikes were, just make sure the sale of the unbalanced condor is inside of those strikes, and I know I'm going to be fine. I don't have to get fancy. I don't have to use my imagination. I don't have to pull up the analyzer. If I'm doing the 60, 65, 80, 85 call, these are calls. All I got to do is sell an unbalance inside of it. So I've got to sell my spread at 65 or higher, and I got to buy my spread at 80 or lower. So 65, 70, 70, 70, or 75, 80, I'm good. Why? 75, 80 is below this, and 65, 70 is above it. That's all you have to do. You don't have to get fancier like you would with a butterfly that you got 25 butterflies. How many can you sell at each strike before you have a sinkhole? So most people prefer the unbalanced condor just for ease of adjustments. But to go in and give all the criteria of strike separation here, I'm probably not going to do this because it's only $15 wide. The only way I would do this one $15 wide is if it was like last week and I'm going to sweat a little bit. Last week, we were stuck in 10-point ranges every day, real close to at the money. We had a gap down of 15 points, and then we go back to unchanged. And then I'm going to push my luck a little bit. But after a 48-point move, we can go through all these strikes on a 48-point move to the downside. I'm not paying 30 cents for something with only $15 of separation. I'm going to go at, normally I won't do it less than $20 separation. Now, for those who don't know what I'm talking about, here's the one spread, here's the other spread. Let me get a darker pen. Okay, 30.25 and 10.15. What's the distance between the inside strikes? Here it's 15. On the unbalanced condor, I usually don't do more anything less than 20. We know on the BWB, I won't do anything less than 15 by 20. So there's going to be a whole bunch of strikes, or excuse me, criteria that with strikes, a whole bunch with price, a whole bunch with everything else. That's going to take up some time. And what I've got is the criteria, because they're all very similar, in columns. BWB, you're going to see strike separation minimum 15 by 20. Then you're going to see the unbalanced condor, no less than 20. So I'm going to want separation equal to or greater than 20. Unbalanced butterfly. Okay. Equal to or greater than $25 separation. Okay, now the question came in, what does 15 by 20 mean on a BWB? Remember, a BWB is the purchase of one vertical spread. Well, normal butterfly would be this. Let me back up one. I'd buy the 30, sell the 15, then sell the 15, and buy the 4100. That is a traditional butterfly with equal strike separation, correct? And what is that going to cost me? Let's pull it up. So we're going to do 30, 15, 0. It's going to cost me $1. Okay. Again, a traditional butterfly will be, if I want to buy a $15 butterfly, I'm going to buy one, sell one, and that's going to be my long spread. And then I'm going to sell a spread, $15 wide, and that's the butterfly. It's going to cost me $1. How do I get it cheaper? By moving my strikes down one. So I'll buy a $15 wide and sell a $20 wide. So 15 by 20 would be buying a $15 spread, selling a 20. Sometimes, especially when volatility is really high, I've done like a 15 by 25 or a 30 by 40. But usually the trade's a lot more resilient and people are a lot more comfortable with something where there's only $5 difference between the buy and the sell. So you'll see 30 by 35, etc. Okay. So does that make sense, Sunil? Did that answer your question? Okay, good. I don't want anybody confused. Okay. So what you see here right now with volatility so low, if I did it really to get close to zero, whoops, let me go with puts. Here's 10 by 15, where it's still costing me money, and that's ridiculous. I will never do a 10 by 15, let alone pay for it. It's too cheap. But here, the difference between these spreads is 10, and the difference between this is 15. Okay? So, going back to the unbalanced, and you're going to learn, you're going to see the same thing on Saturday, but different. Real quick, I'm going to want to be long the 30s because it's above a 16 delta. I want to break even below at 4,100 or lower, ideally. But what if 4,100, you see here, $4,100 has a delta of 5. As you get closer to like 2 deltas, that put's not even going to be worth anything. So why sell it? Okay? You're going to have to play. What I normally do is figure out if there's a resistance or support level real close, resistance on calls, support on puts. I find the put strike I want to own. Usually it's the first play. I want to own the 30. So let's say I go one strike lower, pull up unbalanced. I want to buy the 30s, which means I'll buy the 30.25. Here you see it's 10 cents. For the 30, 25, 15, 10, 1 by 2, unbalanced. That is only $10 separation. That is not a lot. Oops. So I'm going to want to separate it or not do anything. As a matter of fact, when it got down to $5 apart, the last time it got down to $5 apart, we actually did the sale where it was something like this, 20, 15. And said, I'll pay 20 cents for this. Selling one spread and buying two. But what I'm going to do is I know I'm willing to pay up to 30 cents. Let's see how far I can go. Maybe the skew is going to help me. Maybe I can still get $40 separation for 30 cents because of skew. So let's go down to the 15, or excuse me, the 10, $15 apart, 05. You see it's 20 cents. Let me see if I can go down another strike. It's 35 cents. This one I want to, this one's getting $20 wide. That's my minimum. Am I going to do $20 wide for 30 cents? It's a little scary. It's at my minimum, so I want to go wider. You guys have seen me do $60 wide with puts before for free. We've done $50 wides with calls for free. So now I got to pay for something that's only 20 wide. It does not give me a lot of room for protection, and it's going to cost me money. Let's go down to the par. Oh, 95. It's going to start getting more expensive. Now it's up to 45 cents. Well, what can I do to lower the cost? Maybe move my longs down one. If I think tomorrow's going to be a decent day down, this one's not bad. It's not great. If I think we're like, if we ran up like 30 points in the last 5 minutes because of buy programs, I probably would maybe take a little bit of a shot at this, and I'll tell you why. Let's say we got to 41.58 because there was a 28-point move higher just on a $5 trillion buy program. All things being equal, that's going to come back tomorrow and bring us down to 41.30. We'll get the 28 points back in the morning, which puts us right near at the money on our longs. The shorts are below the support line. And even if we have a 50-point down move on the open, that's still 41.08. It hasn't gone through all these strikes of 95 at the low. We'll be able to adjust. Okay. Again, this is just down and dirty without the criteria. Saturday, you're going to get a lot of criteria. But I just wanted to get it out there real quick so that the real remedial stuff, if this is new, may take 2 times of hearing it today and Saturday. And the redundancy of today and Saturday will have it sink in. But it'll be a lot more scientific on Saturday. I'm going to give you just an overview of the thinking, and then Saturday you're going to get the science. Any questions? Okay, guys. Oh, by the way, some people asked about the pair trades. They're a little bit confused. We got 2 pair trades. Let me blow this up a little bit with calls, one with puts. Here's the call. On Friday, all we have is the 66, circle the wrong things. 60, 65, 70, call butterfly, and $678. Okay, that's one of them. Don't confuse it with the other one. I've been doing a good enough job trying to confuse you on my own without getting even more confused. The new one, the second one with calls, is this one. Where we took off half of it today. We sold 3 contracts. We had on 2 contracts of SPX and 6 contracts of QQQ. We sold one, and we bought back to close, I should say, 1 SPX and sold 3 contracts of the QQQ. And now we have half as many of the pair on. So we still have a butterfly for the first pair, 1 short contract that's overlapping of the second pair and 3 long QQQs. And the put one, that one's so far out of the money, it's probably worthless. But we have 5 cents or $5 into it that we're probably going to lose the $5 on. Okay. I wasn't as worried about adjusting the put ones when it only has $5 of risk on it compared to the call ones that had $72 of risk versus, and the other ones had, I don't know, like $100 of risk. But now all the risk is gone. We have $235 in profit on this. And on the first one, we're clean. We have $678 profit no matter what, and 5 butterflies with the center strike of let me show it to you. 5 butterflies with the center strike of 65. So what's it worth right now? Probably 15 cents. But we'll hold on to it, see what happens on Friday. Okay. I understand if you got confused because we have 2 different pair trades, both using the 65-70 strike. We did that on purpose because it showed how the separation from the Q and the S allowed us to buy the 25-27 Qs one time. And then because the Q kept going higher where the SPX stayed flat, the second Qs we bought weren't 25-27. They had to be 29-31 for about the same price. I know it's easy to get confused. Don't worry, I'm not going to mess it up. Even though I did. And that's only because I was getting fancy yesterday when I was flipping them, because I was going to use these Qs at the 29.30, sell them out, 29.31, excuse me, and keep the 25-27s on from a different trade. So I was going to close out half of one trade and half of the other trade to take the best part of one trade and keep the best part of the other trade. But I didn't want to confuse you, so I confused myself. We should be all clear now. If not, let me know. Send me an email, and I'll put in an update one tomorrow so that we're much clearer. Any other questions? Jelly rolls. I have not asked the office how many people want to do jelly rolls. If just 1 or 2 people want to do a jelly roll, I'm not going to do a jelly roll because it takes up a lot of time, and the next day is the mini class. If a bunch of people want to do the jelly roll, I'll be more than happy to do the jelly roll. Great question, Andrew. Let me get rid of this stuff. So I probably should have been more specific. Now, another question is about this class on Saturday is, are they going to be standalone trades or layer spreads? Well, what we're going to end up doing is layering no matter what, because we'll talk about adjustments a little bit. Just like the pair trade, we did 2 pair trades with calls, and we layered up the same strikes on the SPX side, but different strikes on the QQQ side. There'll be some discussion on it. Obviously, it's not a layer class. Andrew, there is in pot, and I haven't done a class like this in a long time. I can do another pot class on layering spreads. I haven't done one in maybe a year or 2, but you can contact the office and just ask for a pod class on layer spreads. And I've got a whole class on layer spreads, 2 hours on layer spreads. Done it a couple times, and they can get you the recording. But there will be a little bit of it in the Unbalanced Birds class. Okay. Other than that, guys, there will also be a little bit of alchemy in there. Obviously, it's not an alchemy class, but when you got the trade on, you got to take it off. It's something of consideration. When you buy an unbalanced condor, how do you unwind it? We're not going to go into all the details and all the permutations of alchemy and all the possible combinations, but there'll be a little bit in there just as a, as a refresher. It's far from an alchemy class. It's going to assume you know nothing about alchemy, but show you something, one part of alchemy, so that you know how to exit, or that there's alternative ways of exiting other than closing out what you just bought. So it'll be a little bit of layers and a little bit of alchemy. Okay? Okay, guys, have a great night. I hope this helps a little bit. And let's have some fun tomorrow. Let's hope we have 40-point moves every day again. I'm getting really tired of the 10-point ranges. There's just nothing you can do with the 10-point range but wait it out. And so we were waiting it out by doing pair trades. Well, we've taken some good money out of the pair trades, about $1,000. But I'd rather do fun stuff than just stuff that buy us time. This 45-point range today was great. I love it. See you bright and early in the morning. Thanks a lot, guys. Talk to you soon. And in a couple hours, you will have the slides and recordings. Good night.